All right, welcome to our Monday night boot camp follow-up. And I want to pick up right where we left off last week. So, welcome back, new and returning students. If you're new, just bear with me, some radical concepts tonight. All right, there's only a handful of people that have turned in their assessments, and I don't know what to make of that. Are you guys not doing them, or you don't want to share them? I need to know if you don't want to send it, that's fine. It's no problem. If you want to keep it personal, I completely understand. But just tell me an email and say, hey, I'm done, man. I'm ready for you to do that portion of the class, all right? You should be following the 12-week year skeleton. You should be posting your scores, or you should be keeping score. There's a handful of people that are keeping score, and they've told me it's made a dramatic difference just in the 2 or 3 weeks we've been looking at it. What I need from you guys is to outline your daily activity and weekly goals. Post it in the Skype group for Monday, but if you don't want to, that's fine. And the other question I had too is anybody in a WAM or doing a WAM meeting? Anybody? Some of you get Stacy is? Okay. All right, not too many. All right, we got to work on that stuff. Believe it or not, earnings season starts this week, but for us it started right after summer break. Okay. All right, so this is what I was talking about. I got a lot of questions. People telling me they're lost, they hate me, they want to kill me. So what are you doing to me? You're confusing me. All right, man. So just bear with me. I promise it's going to come together. If not tonight, next week. But listen, you know the story, how stuff works, right? I'm throwing out some thought-provoking concepts to you, some ideas that there's something else going on. You want to call it conspiracy, whatever. But there's something bigger forces working in the market outside of us. Right? But what I'm doing is challenging the conventional wisdom because I know it's wrong. So the way an idea, right, gets accepted is that first Steve's crazy. Then you go back and look at the charts, then maybe he's not so crazy. So you get some exposure to it, you start thinking about it, you revisit it, and you come to some kind of comfort level with it. And then, right, then acceptance. I'm indoctrinating you into the dark side, I guess. So what I'm hoping to do over the next couple of weeks, what I've been doing is trying to expose you to some radical ideas about what's truly going on and finally help you to understand and implement those ideas. That's the whole point of the last couple of weeks of lecture.
You're getting a little quiet.
I'm getting quiet?
Yep. That's
not like me. You know that. It's got to be the mic. All right, so we ended last week talking about news levels, and you know I'm still hot under the collar about it, so I'm going to pick up right where we left off. Okay, so let's see. I have a video for you guys that's in the archives that I managed to find from a news release, but it's the old color scheme. It's the white and black heat map. But what I want you to do is I'm going to set this video up for you before I play it. Let's suppose that you took a long position prior to the news release and that your analysis was correct, but your take profit is 75 to 100 pips away because after all, it's news, right? But I want you to see what happens next, and I'm going to walk you through it. And this is, again, reiterates why news is bullshit, it's not scalable, and I want you to stop wasting your time with this stuff. There's too much opportunity in the business to be wasting your time with this, okay? Let's get this going. Okay, let me see if I can get it visible. Let me know if you guys can see it. Yes? Okay, by the way, this is the non-farm release of the crude oil, it's called crude oil inventories, and it's similar to non-farm. There's something that happens in the order book that I want you to see is absolutely crazy. So let's walk through it, and I'll stop it and show it to you. Okay, so the dealers are pulling price up towards a level right here, right at 49.60, and then they're going to go into consolidation coming into the news. They're getting positioned now to trade it. Hope this is the right video. Okay, I want you to notice that, see if you can see this. Relatively speaking, these are very small amounts of contracts being executed for crude oil. It's in the thousands. And I think you'll be able to see it right there. Look, this is 8,000 and change. You'll see it when it pulls out right there. Mute your mic, please. Okay, look, relatively speaking, this is nothing. This is 7,900 contracts, 8,400 contracts. You guys see the number, how many contracts are executed? All right, I gotta find who this is and mute myself. I think I got it. Okay. All right. So they're jockeying for position right now. They're getting price situated. And then they're going to do the release. It's going to come up on that dotted time slice line. I want you to notice all the black space in there. There's nobody trading. It's all retail amateurs. White stripes represents dealer book. Okay, there's your release. Okay, did you guys see that? They were right here at 49.76, and the next offered price was 49.5 in the blink of an eye. Everybody that was here is now sitting backwards. Okay, if you put any size on there, look what's trading 1, 1, 2, 2, 6, 9. If you had any size on here, you're sitting down here now negative. Watch it again because it's crazy. Okay, price is at 76. It runs into a brick wall of price. Look, 131. That's relatively small, but because nobody has any power or authority, the dealer can block a price with 130 contracts. Okay, watch what happens from 49.74. Bam. I don't know if you can see it. It's right there. It literally goes 26 ticks down, and this is the next offered price. Every one of these people that were long, even if you positioned yourself well and had a stop here, is in negative float right now and in trouble. Now, if you had a stop loss anywhere in here, your stop was filled at 49.5. You're stopped out. So if you had 25 lots on there, you just took a monster hit in your account. 10 lots, 5 lots, whatever. Overtraded because you were confident about the news. Your take profit was up here, right? Because it's a news release. It usually goes 100 to 200 cents. Okay? They had it. They lifted all the liquidity. They sucked right through all these people, and they offered at 49.5. And then watch what happens after this. You're in a boatload of trouble, man. Look at this. If you didn't get filled or if you didn't have a stop, you're in a lot of pain right now. You're down 50 ticks. And I want you to notice inside the order book, this is where the dealer stopped dealing. This is black real estate. There's nobody dealing in here. It's like I told you last week, nobody's home, man. You think you're going to get filled without getting slipped at that speed of price? There's absolutely no way. You will not get filled. You'll get slipped tremendously. 20, 30, 40 ticks, you'll get slipped. This is exactly what non-farm looks like when you're recording. Exactly. I just couldn't find a recording for you guys. That's the end of the video. I just want you to understand. The biggest devastation comes right when that bubble drops and falls out of the bottom. Right there. Right here. It drives me crazy. Look, 49.75, red bubble pops in right there. 49.51, 49.50. That's why I want you to trade the news. That's the reason. This is not scalable. You're trading, look, minis, 1, 1, 2, 2. These are amateurs, man. Look at the 1,600 contracts. Look what's normally dealing over here. And then the meat of the move is 5,000 orders. These are people that think they're going to beat the news. Amateurs. one contract executed, 2, 3. It's very small amount of money, and they make them pay. Everyone that's green side long pays. This whole row is destroyed. And if you're trading over leveraged in your account, if you got a small micro account, you will not be filled until 49.5, and you may or may not get filled in that suite. So you know.
So Steve, they basically gap the price. Just
Yes.
boom.
Exactly. Yep.
Just drop it.
They ran it up. They got everybody long, and then they dropped it tremendously. I mean, it literally went 25 ticks in one tick because there was nobody to support. These guys ain't supporting price. These guys are supporting price. If you come in, please mute. These guys here are supporting price. Look at the thick of the order book. This is heavy orders, 5,000 contracts, and look where it supports out. Supports out at 49.5. Look at all the book. The heaviest part of the book is right here. All right? All this liquidity is lifted. The book is empty, except for the amateurs trying to beat the news for 100 ticks with one lot. This is the kind of stuff this is not scalable. You can't look. I showed you one from the other week. It was kind of wild. This is crazy. This gap down huge. This is what happens in the news though. This is normal stuff. This is not like, oh, that's an anomaly, Steve. It's not. This is the norm. If you catch a break and get filled, that's the anomaly. That's why it's not scalable. And I just want you to avoid it. I know people are trading the news. I promise you they're not trading any size. And I'm not trying to be disrespectful to anybody's account size. It's not what I'm doing, but it's not a scalable, viable business model. That's all I want you to understand from that. All right? Enough. So there's my news story. Okay, so next. All right. So let's pick up where we were. We're trying to understand the dealer levels and how they're created at the order book level. And that's the stuff we've been talking about with the heat map and stuff. And we started a couple weeks ago with the 3 days of levels, 3 days rise, 3 days fall, then the intraday, and now we're looking on the micro level. So here's what I want you to understand. The order book is the precursor to the move. Therefore, the pattern created prior to price movement becomes the signal itself. Does that make any sense? No confirmation is required. Right now, we use, and the guy starting out new, I'm not trying to confuse you, but we use a crossover on the catch-up, a close. Okay, well, once you start to understand the higher concepts, those signals are actually late to the party. They're good, valid signals, but they require a 15, 20, 30 pip stop. What I'm showing you now requires a 5 to 7 pip stop. That is, anyone that's been around me for a while understands what a game changer that is. First of all, if you're wrong 7 pips 2 or 3 times, you're down 21. You can make that back in one trade easily. If you're right, the risk to reward is enormous. So the implications are huge. Okay. The presence of a bar type creates the next signal when the proper structure is created. I'm going to go over the structure. But just because you can't see it doesn't make it a falsehood. It doesn't make Steve nuts. It's not there. It's there. How did this start for me? I wondered why when I was placing trades, there was almost always some immediate drawdown, right? Waiting for the close above the catch-up, below the catch-up, close of a bar, and you get an immediate pullback, right? So it made me wonder, what are these guys doing that I can't see? And you guys remember in 2014, I got kicked out of the last good broker in America, and I started looking for a place to do business, and it was just a pain in the ass to get settled. But I ended up switching to the futures equivalent of currency, which is the 6E, 6B contract. That's how this all started, because in futures, they have a transparent order book, and it's still not transparent. I showed you last week there's black pool, dark pool liquidity, there's iceberg orders, but it's more transparent than the other places I've dealt in the past. Okay, so what became interesting to me was these little pullbacks, these little areas in the order book, right? We already know we're looking for tops and bottoms. I went over last week how they pressed price into these consolidation zones to form the Asian range, right? We talked about that last week. This stuff here. But what became interesting to me was this. If we could find these edges, these zone flips, and we can deal right in here, right? We can deal at these areas right here. Our stops would be right there. Literally a couple of ticks better than the spread. And I think some of you that are struggling with larger stops and drawdown, Susan, this would actually help you dig out much faster if you could wrap your head around these concepts. Okay, so the structure that is created by the order book is a repeatable pattern, exactly like the macro structures. Zone flip, N's and W's, A's and B's, but on a micro level to the tick. So let's look at this typical pattern that I have. All right, so obviously, right, we have, you guys know from what I've been talking about in the order book, we have low of the day structure, big white stripes, we have dealers blocking the book, and then we have these lower levels of liquidity in here. Okay, if you notice what happens, they come in, they make the W, they take a level and pull back. They take a level, they get rejected up here, they pull back into the liquidity. They break, right, consolidation going into level 2, and they push, they run into a wall, they push into it again, and then you get your reversal, right? This would be your possible M formation. This is your wedge. This is your zone flip right here coming off your apex. All these patterns that we've been talking about, right? This is your shift bar and your pullback off your shift. Then you get your wedge, your breakout to the high side, your typical formation, right? And then looking over here for the move to terminate. All right, so this is how the patterns, the W's and the moves that we talk about are created, and it gives you that, right? Notice in the order book, there's 3 pushes in there, exactly like the larger structure. Reach yourself, please. All right, I'm trying to find out who it is. Guilty. Okay, so when you could see the levels, you have an understanding of what's happening when these little patterns are created. But there's structure to it, and that's the stuff I want to talk about. All right, I'm going to draw it up a little bit and talk about it. We're going to get a good video. I got markers for you guys too. So bad, you guys are killing me with the markers. That video didn't come up, did it? Okay, let's see. All right. Like it's new, you know, come undone. How about now? There we go. All right, there, everybody. Okay, look, new markers. Can you see them? Okay, what color do you guys want? I got blue. What's easier to see? Blue, black, red, or green?
Green.
All right, let's try green. Can you see that? Yes? I can't even see it. I'm looking at it. Let's try black, man. All right. So here's what's going on. We got our structures going in, right?
Okay.
We have our topping out pattern, our flat print. Okay, mute yourself, please. Okay. Usually what we get is our apex nadir type stuff, and we get our block on the top. So we talked about last week about how they press. This would be a white level right here, and this would be a white level right here. Right? And price would rattle. Price rattles around in there in a flat print in between these levels. Now, in order for price to get out of this, one of 2 things has to happen, right? They have to lift the bottom, make a hole in it, or lift the top, make a hole in the print. Go back and look at this picture on the screen. Let me back up, and you'll start to notice it. There's tiny little holes in there. Let me go back 2 slides. I don't know if you can see these little slits where it was absorbed, right? Right here. You see that little slit right there where they went in there? It's almost like that block of orders was eaten into, and it turns black. Okay, if you can see that. So they make a little hole in the order book, just enough for them to run the stops. And they'll come back inside, right? And then they'll break to the downside. But what happens is when they eat through the liquidity, they take out the structural component of the market. So what happens to hold this right here, the dealer has, or collectively, there's buy limits or buyers sitting right here. Okay? So in order for the dealer to get through this apex, or nadir, it's nadir, right? In order for him to get through this, he has to suck those buy limits, and you're going to get one of those Pac-Man bubbles. They look like that. When you get the Pac-Man bubble, price should drop and then retest, and that would be the area there. So now, you're looking to enter on these little pullbacks right here, so you would wait for the structure to come out. So in order to understand what happened without the order book, you have to take out this swing low right here. Okay? So when the market breaks through this swing low, because I just told you that in the book, this area is a white or orange, depending on which book map version, right? This area is holding price to stay above and create the range, right? And there's a stripe right here, or maybe 2 or 3 stripes, if you can see in the picture, right? If you look at the top right here, there's several stripes pressing it. It's squeezing in here. See it? In here, and there's above. Remember I told you that when they make a high of the day, like there's some spacing. See if you can see this right here. Let's say that this was going to be a typical high of the day. They would put some liquidity, some blank space in between with no orders, and they space it out, and it creates the area where the high of the day is going to come in. That's how they create the high of the day, the zone. So if you're looking at, let's say you're looking at this chart, I already can tell you the trading range just from looking at this chart. That's the trading range. Because you have high of the day, low of the day, where the liquidity is spaced out. That's going to be the run for that slice of time, right? Everybody else is an amateur. This is all this light stuff right here. This is all retail, right? And then look on these bars. Look at the profile. Look at this right here. That's a huge amount of orders. This COB is current order book, right? Placed right here. This one has volume on it. See it? That's how those stripes come in. So you can look at the side view, the profile, if you will, and know that the stripe is here. You don't even need to look at this. Because the understanding is that if this is dark white or heavy white, that's like contradiction. If it's heavy white or bright white, you know that this is automatically there. Now, in order for the dealer to come out of the structure, he has to break this piece right here because the white stripe is in the way and there's limit orders sitting here. So what has to happen is the book either gets lifted, makes a hole, or it gets absorbed. Okay, the absorption looks like that, and it starts to fade from heavy. I'll show you a perfect picture of absorption right here. See all this fading? I probably just covered it. See how it was darker and then it starts to fade? These are limit orders getting absorbed. Gone. Right here, absorbed. Right here, right there, absorbed. See how it's heavy and it turns light, or turns dark actually, it's the opposite. Absorption. Okay, so just because you can't see the print on the book doesn't mean it's not going on. This is what's going on. So now your job is to understand this, and I'm going to show you on a micro chart. It's going to leave a pin bar. The pressing of the book is going to leave a pin bar, and it's going to look like this. So this is your precursor to a signal, and then your actual signal. Okay, it's going to come through a level, and what's going to happen is it's going to leave a pin bar right here like this, and then price is going to go down. You have to have a V structure that takes out the previous swing low. Swing low, swing level right there, okay? Now, you can draw a box around this pin right here. This pin and bar that closed down here, this is red and closed low. This created the hole in the order book. My scaling is off on my drawing, by the way. This created the hole in the order book in the push through the nadir, right? And you got a close below. You have to get a close below. You cannot get another pin rejection back up into the range. You have to get a close below or a buy-side close above. I'll draw them both. Okay, now, this becomes your micro box trade. You put a sell limit around the front of the box at the open of the candle, and your stop loss goes right there. 1 or 2 ticks above. If you're trading Forex, it needs to be a little bigger. 7 or 8 ticks total. 7 or 8 ticks total. The dealer is going to come back into this book, this previous level, test it, and you will go high. The advantage to using a limit order is that it's FIFO, first in, first out. Your resting order is ahead of all the other retailers that are clicking the mouse. They're going to get slipped, you're going to get filled, or no fill. That's the only choice. Filled at price or no fill. And sometimes you get holding. You get left holding up there. But understanding that this structure is built because of what you see in this book before it actually happens. So it becomes the precursor to the signal. Let me see if I can erase this chart. Go over a little bit. All right. Okay, so for example, if you were going to go, if you were looking to buy a zone flip, okay, when this flips over right here, there's a pin, okay, so this becomes your micro W, and you would put an order on the top of the pin, at the bottom of the candle body with a buy limit right here, and then you would get taken into the market. Okay, same thing here. You would draw a box, and it's very hard to do with this. You would get taken into the market. Draw a box, right? First one, get taken in, no heat whatsoever. Then you're in, and you move up into profit. So the concept is that you can grab a much tighter order entry and have little to no drawdown. Let me grab a drink. Little to no drawdown on your entries. All right, let's look at buy side. Same thing. Price comes in. There's a white stripe right here. We know that's going to hold. Okay. How do we know the low of the day is going to be formed? Well, it's going to make a W. You don't need the book. You don't need this white stripe. The white stripe is the big 15-minute hammer or candle rejection on the bottom. Right? Then it's going to come back and form the top of the zone, right? Which forms the top of the box. This is the box trade stuff I've been talking about for 18 years. Okay? It forms the top of the box. This is the apex, because I know it's shaped like an A, so I got it right. I got one right. Okay? And then what are we expecting over here? We need this piece of the structure to break, because we know that there are orders pressing this down. There's a stripe right here in the book. You don't need to see it. You know it's there. There's a stripe pressing in here, and there's a stripe pressing in here. Maybe a collection of stripes. White stripes, right? Holding that order. Now, they might lift the hole, hit the stops again, or they might not. But what happens is when price comes above here, it gives you a close. A close above the apex. You need to buy the pullback off of the pin that's created here. You'll get a pin bar. It'll shoot up, paint green. Here, I can even get all fancy on your colors. You'll get a green bar that looks like that. That's your shift bar, right? Okay, as soon as you get a shift bar and you get a close above the apex, there's almost always a pullback back into the white stripe. I want you to measure this bar at the pin and put a buy limit order sitting right there, And I want you to put, it depends on your dealer, man, and what pair you're trading. If you're trading euro and you got a 0.5 pip spread, then you can use about a 5 or 6 pip stop off of the limit, right? But it needs to be outside of this pin because they might trade back to the pin. Okay, so you go here, stop loss is here. Let's call it -7 for argument. Okay, you're going to get taken into the market and reversed out. Now, here's the rub. Like I spoke to a couple people about this to test and see where they're at. And here's the mental rub. You're buying a red bar, and it just blows people away. You're selling a green bar, and it blows people away. Think about that for a minute. You're doing the opposite of what a retailer normally does. Well, isn't that the whole concept of what I've been talking about for the last 18 years? You're doing the opposite of what everybody else does. So you got to wrap your head around that. It's like, I don't know if I can do it, Steve. Well, yes, you're going to do it. You're going to try it on demo. You're going to do it. So here's what's happening. I'm just going to, look, price is doing this stuff. It comes up. You're looking for the pullback right here, the zone flip, right? Okay, well, when price is retracing, the bar is going to be like this. I'm telling you to buy right there. Buy limit order on a red bar. That's what I'm telling you to do. Buy red on a limit. Okay? So your order is going to be right there. The bar is going to be solid red, and you're going to step in front of it and take an order. Not only are you going to get a better order than most people, you're going to buy the bottom third of the bar. Okay? How's that for an entry? You're going to buy the bottom third of the bar and sell the top third of the bar. Now you're talking about a serious entry where you can do 10-to-1 risk to reward on your trades. Why? Because if you use a 5 pip stop and you're going for 50 pips, think about the return on that. That's a 10-to-1 risk to reward. I don't care what size account you're trading. You bang out 2 or 3 of those a week, I'll see you in the Bahamas, the Atlantis. I'll meet you in Nobu. 10:30, I'll be there. All right, you understand? You buy red at the lower third of the bar, and you sell green at the top 1/3 of the bar. It's a huge difference in how you execute. Now, Steve, there's nothing to see it. I don't understand. Okay, it's a stretch, but what you're trying to do is you're trying to find where the dealers do their business. Okay, so you're trying to execute in the rejected portion of the bar, right? This is the rejected portion of the bar. Well, why is that significant? Well, because we already know by looking at this bookmap stuff over here that the rejected portion of the bar comes from that shit right there, the stripe, right? So if you know it's going to get rejected based on a stripe and it shows you, this is the precursor. This is showing you that there was a stripe there. Now I know there's a stripe there. And I know the dealer did a Pac-Man on it, right? He ate into it. This is, if you look at the slice, it's like this on the colors. It's green, and this is red. Right? It looks like a little pie. I call it Pac-Man. That's the best Pac-Man you're going to get out of me. All right? So if you understand that this went off right there, and there was a stripe there, now you know that this area is striped. We know this area is striped. Now, what do we expect? We expect price to shift away and then work its way back in here, and you go sell limit on a green bar. Stop right there. Okay? You don't need this fancy tool and this data feed and all this bullshit, because this is an M or an A or a zone flip. Okay, it happens again. The same thing happens again. Price shifts away, and then we take this pin, right? There's usually a pin that forms out the nadir, and it runs back to the high, right? Depending on the pair you're trading, this could be about a 20 pip structure. Back to the high, 20 pips down, 20 pips up. About a 5 to 7 pip rejection. This is the stuff you should know about your pair. 5 to 7 pip rejection zone, right? The box is 5 to 7 pips. If this is 7 pips and it's too big, you have to go a little bigger. and you try to place your order maybe mid-box and use a 5 to 7 to give you some distance off of it. Or if you're uncomfortable with that, then you use a 10-pip stop to make sure you eat through the box. Because we don't know how deep that pin is going to swing, and then they open the spread against you too to screw with you. Okay? Depends on where you're dealing at. They might not. You might have a half pip spread and might stay consistent. Okay? So understanding that this creates the swing back, or this coming through creates a bar, a red bar that looks like this, then we know they're going to retest the strike on a drawback into the area, right? And I talked about that last week. Why? Because they didn't get all their orders on the numbers and the cells of the bar, right? Every bar looks like this. And just like all those orders, there's some number of orders in here, right? It could be 27, 8, 35, 105, 15, I don't know, 21, 60, right? There's numbers in here. Okay, so when a dealer drives the bar through price and he's trying to sell, he wants to get rid of 29 contracts. Okay, well, he puts 29 offered and maybe only 15 go through. He does it again, he's pushing. He has 62 over here, and maybe out of the 62, only 30 go off. So that's his little zone, right? So what does he got to do? He has to come back and work into there and try to offload these. The remaining contracts that were not absorbed or distributed or sold or placed into a retailer's hands, those orders were not placed. So in order to get his float, his amount of money off his books and into the market, he has to retest the area and come back. So when he swipes through, he gets some number of buyers or sellers. And then he comes back and retests, and he's looking for buyers here on the leftover order cells. And I'm going to give you a bar blow up next week to show you that, what I'm talking about. And this creates, yes.
Could you run through like a sample trade doing that? Like, okay, you see this happening, and
Absolutely, and I have some charts too tonight, but I'll send it up for next week for sure.
Awesome.
Okay. All right. So what happens is he needs to dump his. He needs to.
Trouble connecting to the internet.
Okay.
Take a look at the help section in your
Alexa, stop. I don't know what the problem is. I'm still on, right? Yeah. Still got internet. Okay. All right. So when the dealer pushes through, they're trying to offload their book. In order to offload their book, they leave footprints on the chart. You can't see the stripes, but this stuff is there. It's happening. Okay? So the structural pattern, the behavior, the little tiny swings that look exactly like M's, W's, and zone flips and A's and V's is what caught my attention, right? So the structural pattern we just went through. All right, so now, see if you can find them in here. Mark it up real quick. I'm going to shut my head off. Side of my head, and just take a look at it. See if you see anything. It's in there. Take a picture of that. I heard him snapping. Take them. Grab this up. We're going to look at it. I'll give you a minute just to see if you see the structural patterns in there. If you can catch a run, there's an unbelievable amount of opportunity in there. And I'll tell you about a student, exactly what they're doing. And they're literally doubling their account once or twice a week. It's a small account, but that's what they're doing. And they're not drawing a lot of attention to themselves because the size isn't that big. All right, we good? Okay, so look. Okay. So what we have here is this is a 1 minute chart. You have box trades, right? Here's a rejection off of a high. Creates a box. You're looking to put a limit order right here. You're in. Stop is right there. Okay? You get a pin rejection. See the pin? It doesn't quite make it back to the box, but over here it does. You're in. Stop is right there. You have, these are what I call zero entries. Zero or near zero entries. You're talking about a 2 to 3 pip excursion against your position, and then you grab the impulse leg, right? I want you to notice that this is the big structural M formation for the day, and this is the zone flip. That's why I drug it across. Okay? You get a push back, pull back into the zone flip. There's your opportunity. Notice that each time you get a V before price pushes back up. Right here, back and forth. Look. These V's right here, this is evidence of the stripe in the book. What stops that? What stops this? The book. The stripes in the book. Stop it here and stop it here, dead. Then it comes back, takes out the level, comes back and retests the level. Comes back and retests the level. These patterns have been driving me crazy forever. Comes back and retests the level. Pin rejection, engage. Here's a little tiny wedge, falls off, flat, back down. Look, pin rejection. This just goes into level 2. You get that 3 print. This 3 print, I posted some of these trades that I've taken, and I'll dig them up again. This usually happens around London Open. You guys seen this 3 print coming into level 2? I always take, I don't know if it's going to be a 2 or 3 print, so I always take the trade right here, and I sometimes get a scratch with a couple of pips, and then I'll catch this one, and it'll be the run. And I'll show you those. Okay, look. Pin rejection. Little V pattern. Next impulse. If you get scratched on that, you come back in here. All right? This is the 3. What you're looking for is structurally, you need evidence that the book painted a stripe and drove price back up, which is evident in a V. Why a V? Notice that each one of these V's gets taken out over here. Right? That's the thing I talked about. They have to get a close below, right? Here's your zone flip. You get your close below and your retest back here. If you just took that trade on a micro level and used 5 lots with a 5 pip stop and put 50 pips on the table, you're talking about a massive return on your trade. A massive return on your trade. All right, so does everybody see that? Okay. You would literally, let's say you were going to buy, right? Your limit would be right here on this box. I'm sorry, you're going to sell. You would be selling a green up close to the tick in the top 1/3 of the bar. That doesn't make any logical sense as a retail trader, but it makes perfect sense as a dealer. Who do you think is taking this trade? Who do you think is taking that trade off of these people that are long? Who's selling? Dealers. It's in the book. It's right there. It's right here. Dealers, 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 buying long, right? Buying off the longs, selling right into that, selling right into that. You don't need the book to understand that that stuff's going on. It's there.
Hey, Steve, it's Vinesh here. How are you?
Hey, how are you, bro?
Good, man. So what's the best time frame? That chart was from a 1 minute or a 5 minute chart?
Well, that's the thing is you got to find your groove.
Okay.
It's the 1 minute. A lot of people get scared and get shaken out. I've experimented with this with a handful of people. Some of them like the 5, some of them like the 1. I know Jim likes the 1.
Mm-hmm.
He has a lot of research on that on his zone flips. If you want to look at some of his work, I know Paul Kelly likes the 5. Jay likes the 5. There's a couple of guys that like. It just depends. I look at the 5.
Okay, got it.
But I want you. The opportunity is it's
everywhere
in these charts. The thing is, the biggest problem that I found is this: is that when you convert down to your entries, you get lost in all this garbage, and you lose sight of where you are. So you need to still do your regular 60-minute and 15-minute analysis, and then find where you think the high of the day is coming in, and then drop down to the 1 minute and try to make your entry. And then once you get separation, you go to break even, manage the trade on a 15-minute. Don't let every little tick bother you. What I was going to mention to you, there's a student. She doesn't come around anymore because she's doing really well. And I think that's the whole point, right? To not have to come around anymore and hang out with me. I'm not that entertaining. What she's doing is this, she is trying to enter early in the run, but she's building multiple positions. So she would take her first trade here, maybe her second trade here, and then she would try to catch the flip and take her third trade here. And then what happens is you got about a 15 pip run in here, but her average position would come in around position 2, right? If you figure out, if you look at the moves, it's almost a perfect measured move, right? So this would be mid. So her average position is 2. If she can get 3, and she can get her stop out in front of the first 2, she lets this piece run, and this doubles her account. That impulse doubles her account. And she does that about 2 times a week. So, and she uses 1 or 2 pairs that she focuses on. So she might go, depending on the account size, she might go 5 lots, 5 lots, 5 lots. And then when you get a little separation on 3, stop goes out in front of 2, your average position becomes the mid-range. So if you can get break even in front of 1 and 2, just leave this alone, right? You need to go out in front of 2 at about plus 3 or 4. Just do the math. It's different every time for your break even. This is your break even plus 1 to cover commission. If you can catch the impulse run for the day, you'll double your account. If you're using 1 to 2% risk, you don't need to go 10% risk and get all crazy. What happens is you're actually leveraged. Let me see if I can erase this. You're actually leveraged as if you're at 5% risk, but you're not risking 5%. It gets higher as you add, but the thing is you block the equity. Okay, so if you use 1% here, 1% here, 1% here, and 1% here, you're leveraged on 3%. But as soon as you go to break even, 2% is protected. So actually, it's all protected. I'm sorry, 3% is protected. Because if your average break even is here, you have no more risk. So once this impulse starts to move, you get your stop here, add a position, you only have 1% at risk. Right? When she goes to put 2 in, if she could block here, she only has 1% at risk. Each interval only has, well, that was weird. Okay. Erase here. Okay. Each interval only has 1% risk at any given time. So you're keeping your risk under control and you're blocking each order. And you're allowing yourself the opportunity to catch a monster run by risking, right? You're grabbing here, you're grabbing here, and you're grabbing here. These are no drawdown zones on the chart. They're no drawdown. Okay? The worst that could happen is if the dealer comes in here and hits the stops above, right? You might have a 3 or 4 tick drawdown. Depends on the pair. Okay? If you're trading more volatile stuff like pound yen, it's not going to work out for you, man. They open the spread. It's very volatile. It's very whippy. But if you trade euro, pound dollar, Canadian, something that's somewhat calm and has a manageable spread. The spread is huge. I'm dealing where I'm at 1 pip spread on every instrument, and they don't screw around with it, man. So the dealer makes a difference. You have to open your stop based on that. But okay, so if you can't do a 3 pip stop, you use a 7. 7 needs to equal 1% risk. All right? I didn't finish, man. It's 8 o'clock. I'm going to dump you guys. I'll pick it up next week. We're not going to do the break next week. The break will be 2 weeks out. So next week, I'll finish this stuff up. I'll have some charts and trades. We'll look at it. I'll pick up right where I'm at. I'm on 20 to 34, and I have another set of charts, and I'll dig up that other stuff I mentioned. All right? I don't want to keep you, and I don't want to drown you in one day with all this information. Just think about
Steve,
Yes.
please, how are you?
Good. How are you?
I'm all right, thanks. Please, may you put that marked up chart, the one with the black lines, which you did. I just want to practice on it.
Sure.
And yeah.
Yeah, I'll throw it in the form in a little bit. I'm gonna go eat
All right.
something. I'm gonna go eat something and put my kids to bed. After that, I'll do it.
All
Around
right, thank you.
another hour or so. Give me some time.
Okay. Thanks.
All right. Just hold your questions to next week. We're gonna cover it. We'll go over this stuff. And then the week after, I'll post all these recordings so you guys can get caught up mentally. Just think about it, man. Don't drive yourself crazy. Just understand that there's forces that you can't see. But I'm showing you where the forces are. They're on these turns. The forces are here and here. Here and here. Here and here. Okay? And the forces look like that. You can't see them doesn't mean they're not real. It's like Santa Claus. We know he's there. You just can't see him. Right? Okay, man. I'll see you guys next Monday. Have a great night.
Yeah, thanks, Steve.
Good
Thanks,
night.
Steve.
Thanks, Steve.
Thanks.